Hello friends, welcome to Learning Sessions, and today in this video we are going to discuss about the capital budgeting for international project investments over there. So this chapter is actually important, and further we are going to discuss each and everything in detail. So stick to the video till the end of the video, and further if you have not gone through the previous videos, kindly do follow the previous videos too. Simply just subscribe to the channel right now and press the bell notification icon so that you get updated whenever we upload the new videos over there. So let's start the session over here, and it's related to the capital budgeting for the international project investments over there. Let's say the case that we are having a company over here in India and the other one is in particularly overseas over there, and particularly what we want to do, we basically want the foreigners so as to invest into our company shares over there. For that particular purpose, we'll be basically doing what? We'll be giving the equity shares and we'll be keeping those equity shares with the domestic custodian over there, and further over here there will be a custodian agreement with the overseas depositories over there, and this particular agreement will be with the overseas depository, and depository agreement will also with the Indian company over there. We can say it will be a tripartite agreement between the overseas depositories, between the domestic custodian, and further between the Indian company over there. And further, now this particular overseas depositories, based upon this collateral, will be issuing the ADRs and GDRs, that is the American Depository Receipts or the GDRs over there, and the investors can be investing into these particular ADRs and GDRs over there. But let me just tell you, first of all, it is not equal to that one share is equal to one ADR or one GDR over there. That is not true over there. And also, even though the price of, let's say, one share in India is rupees 10 over there, and let's say in one GDR there are 10 shares, the price of one GDR will not be equal to 100 rupees equivalent over there, because it all depends also upon the money and demand supply over there, right? So after that, it's related to the foreign investments in India. So whatsoever the investment things which are available to us are mentioned over here. First of all, it's related to what? It's related to investment in listed or unlisted company over there, like except through the route of the stock exchange, how the companies can be investing into the Indian markets over there. And further, here comes a picture of the foreign direct investment, that is a FDI over there. And the second one, we are having the FVC, that is a foreign venture capital investors over there, who will directly be investing into the companies over there. Let's say case the A companies over there in foreign, and further they directly invested into company, and they basically injected the capital into the company, but not through the stock exchange over there. So that basically is what? That is actually the foreign direct investment, or that can be either by the way of the private equity or the foreign venture capital investor over there. The second thing, it's related to the institutional investment, is basically through the stock exchange over there, where the investors, that is the foreign institutional investors, are going to invest in the stock exchange over there. They are not going to basically direct pour money into the company over there, or private equity into the capital in the company over there. They are just going to buy or sell the stock of a company from the stock exchange over there, right? That's related to the foreign institutional investors over there. And the second, it's one related to the ADR and GDR, the way I just told you, related to the ADR and GDR over there. And further, we are also having the investments by the NRI persons over there, or the persons of Indian origins do invest into the Indian economy over there. Okay, so this is how the money can be invested into India over there. So foreign investments in India over there. Now let's have a look at the fact that the capital budget is particularly dependent upon what? Like I told you, that what will be defining your capital budget, that what capital do you require? It basically defines upon what? That what are your expenses on your fixed assets over here, and as per that you will be requiring the funds with you, right? And further, the main process and the main reason or the main objective, we can say, related to the capital budgeting is what? That we do require the capital fund, that is basically for the fixed assets over there for a long term basis over there, so that we can have a sustainable growth over there, and further we can also be having the expected returns over there. And further, there are many of the issues which are faced when by an international entity over there, because when they are basically going to look at the project over there, there are many hurdles. That's the case that you are going to basically analyze a project over here in India. What are the different hurdles? It could be related to that what will be the project cost over there. You are to analyze the different costs over there, fixed cost or variable cost or other things over there. It could be related to the manpower do you require. It could be related to the raw material do you require, or something like that. But when we are talking about the international market, these all issues are present. But other than that, there are some risks which are present over there, like the currency, foreign currency risk is available over there, because because there are currency fluctuations. When you basically are going to transfer the funds from or converting the funds from one currency to another, there is foreign currency exchange risk, there is a country risk which is present over there, political risk is present over there. So there are many risks which are present over there, and further which can do impact the projects adversely. Now let's have a look at the effect that the foreign investment analysis over there. So as I told you, first of all, it's related to the exchange risk. Now what do you mean by the exchange risk over there? Let's say case that the currency price today is 1 USD is equal to 76.10 INR, right? Let's say, just assume that this is a price right now, right? And in that particular case, what if I'm going to invest my money in foreign country over there, and further the day when I was to invest, the prices increased to 88.40 INR. Now definitely my initial investment cost will now be increasing over there, because I have to convert my money into the USD at the current price over there. Although there are different ways that we can do hedge our situations over there, but we will be talking about them about later. But right now you need to understand that definitely there is a probability of the exchange rate risk present over there. And the second one, it's related to the transfer risk over there. Now let's consider MNE over there, or the MNC over there. It's related to the multinational enterprise or multinational corporation over there, which is actually available in the different countries over there. Now sometimes what happens, they are to transfer their funds, or they are to transfer their assets or their produces from one country to another. And definitely that case is what they do, what actually they are to transfer at some price. Let's say the case that company ABC is over here. We are having company ABC over here, which is having a multinational office in some other country, let's say XYZ over there, and further they are to basically deliver a lot of the sales goods or produce to the other country over there, right? And at what price they'll be offering the goods to them, so that they can save the taxes, because the tax rates may differ in the different countries over there. And it may also be the case that they are shifted to the tax havens over there, where the tax rate is nil or very low, so that they can save taxes over there. So there are some issues which are present over there that's related to transfer price over there. And the third one, it's related to the political or the country risk over there. Now the political situations in each and every country are different over there, and definitely it may also be the case that you're dealing with one country, or there is particularly a company which is actually available in both of the countries over there, and it may be the case that there are some hurdles from the political side, or the country has basically pushed a ban on some other country related to imports or exports over there, due to which your business may get impacted, right? And further, let me just tell you, first of all, it's related to that you can adopt a currency conversion rate over there, particularly cross-country conversions over there. We need to take care of the different things over there for that particular purpose, right? And the second one is related to if the project implementation is going to take a long time, because we are going to we are basically talking about the projects which are of a longer duration. Let's say case we are working on a project which is of a duration of 5 to 10 years. In that particular scenario, what if the different things change? What if the different things never went like you basically assumed them to be, right? So those could be the different things related to it, like the rate volatility can be there, and further it could be related to case whensoever imports and exports are there are borrowings or repayments over there, or it could be the case that you receive the dividends, or there is repatriation of the profits over there. You are to basically transfer it to the other country, and definitely when you're going to transfer it to other country and they'll be converting into their home currency over there, there can be the fluctuation and it can affect your profits adversely, right? Now let's consider the fact related to the classification of investment projects over there. First of all, it's related to classification by project size over there. Now project size, there may be the small projects, there may be the big projects over there. Now small projects can be approved by the departmental managers over there, whatsoever the departmental managers, they can approve themselves. But if it is a big project, in that particular case, the board of directors approval may be required over there. And further, it could be related to by the type of the benefit to the firm. Now it may be the case that the particular project is not having that much benefit. It may be the case that a project may be increasing the cash flow over there. It may be the case that a project may be decreasing our risk over there. It may be the case that it may be having an indirect profit or indirect benefit over there, right? So that particular case is related to by the benefit to the company. So we can basically be saying there are different type of projects depending on that. And further, it's related to by degree of dependence over there. Now, what do you mean by dependence over there? Let's say case that we are having the different projects, project A and project B, right? we are having project A and further project B over there, and it could be case that these two projects are mutually exclusive. When we say that the projects are mutually exclusive, it means that both A and B can be executed, and further it means what? It means that both A and B can be executed, but we can be executing only once at a time particularly, and further not the both over there. That means the projects are mutually exclusive over there. And when we say the complementary projects over there, it means that if we take the project A, if we take particularly one project over there, it's going to basically uplift the other projects also. It may be increasing the cash flows in the other project also. In that particular case, we say that it's a complementary project. And when we say it's a substitute project, it means if we take one of the project, in that particular case, the sales or the cash flows in the other project will decrease over there. That's by the degree of dependence over there. So we are having the three cases. One, it's related to the mutually exclusive projects. Other one, it's related to the complementary projects. And the third one, it's related to the substitute projects over there. Now after that, it's related to by degree of statistical dependence. Now what do you mean by statistics? Statistics means it could be the relation between the two projects over there. Okay, so it could be positively related, positively dependence over there. Positively dependence means what? Positively dependence means that if the cash flows in A will increase, the cash flows in B will increase. If cash flows in A will decrease, cash flows in B will decrease. Means proportionate, directly proportionate over there. Or it could be the case that there is negative dependence, that if the cash flow in A will increase, the cash flow in B will decrease, or vice versa, right? And the third one, it's related to when those two projects are not related to each other, right? That's basically statistical independence over there. And the fifth particular classification is as per the type of the cash flow. Now if we look at the conventional cash flow over there can be only one change in the cash flow side over there. Like you basically invested the money before and now you're just going to receive the amounts over there. That's basically related to traditional approach. And the other one, it could be related to that you basically invested once and after that particularly you received a big cash flow inflow before, and further after that there are just outflow and outflow. That's particularly related to the conventional cash flows over there. But non-conventional cash flow can also be there, where there can be different combinations related to the inflows and outflows. Now this plus sign is basically indicated in the inflow, the minus sign is indicating the outflow over there. So it could be a combination related to the different signs of the plus minus over there, inflows outflows over there, right? Further, it's related to the foreign currency discount rate computation. Now let's consider one fact over there. There are different types of currency rates which are available. Let's understand this particular fact. There are different type of currency rates which are available over there. One, it's related to ready rate. One, it's related to ready rate, which is also said to be the cash rate over there, and it works upon T+0 basis. That is a settlement is on the same day over there. And the second one, it's related to tom rate. Now tom is basically related to the tomorrow, right? And further its settlement is on T+1 basis over there. And further the most popular one is a spot rate, SPOT, spot rate over there, and settlement is on T+2 basis day over there. And all the days must be working days in both the centers over there. Let me just explain to you. That's the case that the country A basically transfer funds from A to B over there, and the funds were transferred from 25th over there, right? And the funds got settled on the second day, right? Not on 26th but on 27th, not on 27th but also on 27 over there. Let's say on 27 the funds were settled, over there, right? Now in that particular case 25, 26, 27, all the days must be the working day in both the centers A and B over there, so that we can say that the rate concluded was the spot rate over there, right? Now after that, any period that is basically beyond the spot rate over there, that is actually said to be the on that particular period, what rate will be applicable? Forward rate will be applicable over there, right? Like let's say I want to basically buy USD after one particular month, which rate will be applicable? It will be the forward rate which will be applicable over there. Now let's understand with an example over there. We are having 1 USD is equal to 76.30/40 INR. Okay, so that is the price which is given to us, and when nothing is mentioned over there, we just consider it to be the spot rate. We just consider it to be the spot rate over there. Okay, now on the left side of the slash we are having the buying rate, and on the right side of the slash we are having the selling rate over there. Or we can simply say that the buying rate in this particular scenario, this is basically two-way quotation. This is actually the two-way quotation over there. So the buying rate in this particular quotation is 76.30 and the selling rate over there in this particular quotation is 76.40 over there. Is that clear? Now, let me just tell you one other thing, that how we can calculate the forward rate. Forward rate is basically equal to spot rate. It is equal to spot rate plus minus forward points over there. Now, there can be two conditions. There can be actually two conditions related to it, that either the currency in the future that may be available at the premium, that let's say previously the price was 78.30, buying price was 78.30, but now it increased to 78.50. That means the currency is available at premium over there. Or it may be the case that the currency may be available at discount. So this was the case related to premium, and it may also case that the currency rate was dropped to 78.10. It means the currency was available on discount over there, right? There can be two scenarios, and we are interested into what, that we want to calculate the forward rate over there, and it's quite easy. Now let's have a look at the factor. Let's say case that you are having the 1 month forward points are given to you. 1 month forward points are given to be 40/50 over there. Now these are the buying forward points, these are the selling forward points over there. Okay, now let me just tell you one simple scenario. If the selling forward points are greater than the buying forward points, okay, if the selling forward points is greater than the buying forward points, in that particular scenario, we say that the currency is available at premium. Simply, we do say that the currency is available at the premium, and further, whatsoever the forward points we are to deal with, buying points or selling points, we will be adding them up. We will be adding them up. Okay, that's related to the when currency is available at premium. Now, if the selling forward points are lesser than the buying forward points, in that particular scenario, we say that the currency is available at discount. The currency is available at discount, and we are to subtract the forward points over there. Now, we are provided with the 1 month forward points over there, and further, let's say we are to calculate a 1 month buying rate. We are basically interested in calculating the 1 month buying rate, right? Now, for that particular scenario, what we'll be doing? First of all, we have to look whether the currency is available at premium or it is available at discount over there. Now, we say that the selling forward points are 50 and the buying forward points are 40. So, these are the selling forward points, these are the buying forward points, which are greater than the buying forward point. So, this is the first scenario over there that's related to premium. That's related to the premium over there, right? Now, in that scenario, what will happen? We are to add up, because the currency is available at premium. We'll be adding the forward points. Now, what is the buying rate in this particular quotation? It is 76.30. So, buying rate we were basically interested into. So, it is basically 76.30. It is your spot rate. This is your spot rate over there. And what are the forward points over here? The forward points for buying forward points are 40. These are 40, 0.40 over there. And we saw that the currency is available at premium over here. The currency is available at premium over here. So we'll be adding them up. We will be adding them up. So what will be the price over here? It will be 76.70. So this is a 1 month buying rate. This is 1 month buying rate over there. I hope that you must have been clear with all these concepts over there related to how basically we can calculating the currency rate over there, right? How we can be computing the discount rate or currency rates over there, right? After that, it's related to forward rate and the future contract over there. Now, let me just give an example related to future contract. So, we'll be understanding it by way of the shares over there. Now, what are futures? What are futures? Okay. Let's say the case that you are having a capital of rupees 10,000. You are having capital of rupees 10,000, and further you want to deal in the share of ABC Limited. Okay, ABC Limited, and its share price is right now at rupees 100 over there. So how many units of ABC Limited you can buy? We can do by 100 units of, we can do by 100 units of company A or 100 shares of company A, right? Now let's assume that this particular price dropped to 95 over here. This particular price dropped to 95. Now, what is your capital amount? My total capital was rupees 10,000 over there. Now, what my new capital amount would be? It is particularly 9,500, because the price dropped to 95 rupees. So, it will be 95 into 100. that is equal to what? That is equal to 9500 over there. And what was the loss of capital? It is particularly previous capital, that is 10,000 minus 9500 over here, that is equal to 500 loss. That is equal to 500 loss over there. And also it's a case related to benefit or profit over there. That's the case that price basically grew to rupees 105. Now my net capital is 10500 over there, right? And what is net profit? The net profit is plus 500, and this particular scenario the loss was minus 500, right? So that was the scenario. Okay, now but in the case of future, that particularly gave you leverage, that particularly gives you a leverage over here. How come leverage? Because in this particular scenario, you're not to basically buy the, you're not to basically pay the full amount, not to pay the full amount over there, right? We are just to pay what? We are just to pay the margin money. Let's suppose that the margin that we need to pay is 10%. We need to pay 10% of the margin money over there. Okay. So for that particular purpose, and also the futures are dealt in lots over there. These are dealt in lots over there. Let's say the case that one lot of ABC future was comprising 100 shares. So one lot of future is equal to 100 shares over there. So this is the minimum quantity that you can deal into. Let's say if I'm going to purchase one lot of ABC future, in that particular case, what will be the total cost? If it is basically at 100 rupees over there, it will be 100 into 100, that is equal to 10,000. And I am to pay what amount? I am to pay the margin amount only. Margin amount only I am to pay, not rupees 10,000. I am to pay the margin amount of rupees 1,000 only, and further I can be investing into one future. This is basically representing one future over there. This particularly is representing the one future over there. Is that clear? Okay. Now the same example. Let's the case that you are having rupees 1 lakh in your hand. Sorry, you were having rupees 10,000, not 1 lakh. You are having rupees 10,000 with you, right? And further, you can actually be buying a lot of units from here. You can actually be buying a lot of future units from here. That's the case that we invested rupees 10,000 as margin, and further we dealt in futures total amounting rupees 1 lakh. Okay, for that particular purpose the margin paid was rupees 10,000 over there. Okay, now let's say the case that the price of one scrip basically grew to rupees 105. Now how many units were there in this particular futures? Total loads were basically 100 lots, but how many futures were there? There were 1 lakh. How many shares were being dealt? 1 lakh divided by 100, that is equal to 1000 shares. So basically just by paying margin of rupees 10,000, you basically having the hold of rupees of 1000 shares over there, hold of 1000 shares over there, but you're not owner of these shares. You're not owner of these shares. These shares are being bought in your name, but you're not true owner of these shares over there. Okay, now the price is given to rupees 105 over there. Now what will be total benefit? The total benefit will be of rupees 5,000. You basically made 5,000 rupees from 10,000 only. From 10,000 only. Previously in simple scenario where we basically invested into capital over there and had the ownership, we basically were able to earn rupees 500 over there, but over here we earned rupees 5,000. And the similar way, let's the case the price dropped to rupees 90 over there. Now what will be the total loss? The total loss will be 10,000 over there. The total of your capital wiped out. Total of your capital wiped out. Now this is exactly said to be what? This is basically said to be the leverage. This is said to be the leverage over there. Now just by having rupees 10,000, you kind of had the ownership of 1,000 scripts, 1,000 shares over there. Alright. And also leverage comes at a cost. Comes at a cost that when the price dropped, this was the cost that you had to pay. Okay. Is that clear? Now let's understand the differences between the forward contract and the future contract over there. Now let me just explain the forward contract also. Like I told you that I'm going to buy 76.10 USD is the current price, and I'm basically going to deal in USD after 2 months. But I'm concerned about what after 2 months the price basically will maybe increased. The price may be increased. So I can go to the bank or can ask for a forward contract. Can ask for a forward contract. Now both the forward contract and for the future, both are the derivative contracts over there. Both are the derivatives, right? The derivatives are those whose values is basically derived from the underlying asset and they are not having a value of their own, right? So in case of forward contract, it's an OTC contract. OTC contract means over the counter. It's a over the counter contract. Whereas the future are what? Futures are exchange traded. You can do buy and sell futures on exchange, but you cannot do buy the forward contract on the exchange over there. It's a counterparty contract, over the counter contract where two parties will be involved. Let's say case I basically A went to person B that I want to buy USD after 2 months. So B quoted me a price. B quoted me a price. Let's say he quoted me the price of 76.90 that after 2 month period. After 2 month period, whatsoever the market price will be, you are to buy the USD, this particular quantity, let's say 10,000 USDs were to be purchased, that you can buy 10,000 USDs at 76.90 over there. Okay. Now first scenario, it could be that after 2 months, the market price of the USD was 75.80. Now the price was lower, but I'm already under a contract. and I'm having an obligation that I'm to buy 10,000 USD from the B only. Rather over here, the price is lower, but still I have to basically abide by the rules and go for the agreement over there. If I won't be fulfilling my contract, I have to pay the swap charges to person B over there, right? The second case, it could be that when the market price of one particular USD is 78.30. Now in this particular scenario, the price is increased and this particular agreement is going to benefit me. Okay, is that clear? So that's related to the forward contract over here. So let's understand the differences between the two. As I told you that it's a buy and sell agreement of an underlying asset related to it. Okay, so that's particularly the forward contract, that you want to buy a specific quantity or specific at a specific price over there in future date. That's a forward contract. And further particularly, it's related to, you're basically going to in a future contract is particularly related to what? You're going to basically exchange the asset for cash at a fixed price and a future specified date over there. And particularly the trade will be settled, and the futures are used for the speculation purposes also. These are used for the speculation purposes also, and also for the trading purposes over there. And also there are genuine buyers and sellers over there, which ultimately settle down the trade in the last date over there. Okay. So there are basically cycles. Let's say the case that one future is available for 7 days cycle over there. So that particular trade will be available for 7 days. Up to 7 days, the buyers and sellers will be speculating the prices, and ultimately on the 7th day, the particular contract will settle down, right? And this is, as I told you, it's a OTC contract. This particular forward contract is OTC contract, that's over the counter contract, so it's tailor-made contract over there, whereas the futures are standardized and are traded on the stock exchange over there, as I told you earlier, right? And the settlement in case of the forward contract is on the maturity date, that on the maturity date only the person will be paying you the amount and you'll be paying the foreign currency to the person over there. But in the case of future contract, the daily settlement is there based upon the MTM, that is mark to market value, basis. And if we talk about the risk over there, the risk is higher in case of the forward contract over there. Why higher risk over there? Whether the I told you that the leverage was present, but higher risk is present because there is counterparty risk. What if the other party basically said that we don't want to abide the contract over there? So the counterparty risk is quite high over there, right? And further, these are private agreement over there. Definitely there is a chance that the default may occur over there, but that's not the case with the futures over there, because they are traded on stock exchanges. They are basically exchange traded particularly, and there is no counterparty risk. And if you look at the size of the contract, that particularly depends upon the terms and conditions over there. But in the case of the futures, the contract size is fixed and no collateral is required for the forward contract, but the initial margin is required for the future contract over there. And maturity is as per the terms and conditions, that whensoever you require some commodity you want to deal into, the maturity will be on that particular date. And for futures, it's a predetermined date. It's a predetermined date because futures are standardized. These are standardized contracts. These are the standardized contract. And if you look for the liquidity, because these are OTC contract, so these are between two people only, so the liquidity is low. Whereas in case of futures, these are stock exchange traded, so the particular liquidity is quite high. Okay, so that is particular difference between the two. After that, it's related to international portfolio investment and institutional constraints. Let's have a look at it. So let's now talk about the international portfolio investment and the institutional constraints over there. So now if we talk about the individual can actually be annually sending an amount rupees of USD 2,50,000 per year, per financial year under the LRS scheme, that is a liberalized remittance scheme over there. So whether it's related to the family maintenance purposes or for the education purposes or for medical purposes or gift purposes, or we can say immigration purposes, the person can be sending an amount of USD 2,50,000 per financial year under the LRS. And definitely there was introduction of the investment alternatives over there, like particularly there are intermediaries. Let's say case that you just invested into some mutual fund, which is further investing the money into the stock exchange or in the mutual funds over there, or particularly international stocks over there, or country funds over there. That's related to what we say this as the intermediary investments over there. This basically say, look at the intermediary investments over there, we can say investment alternatives over there. And the second term associated with over here, it's particularly related to international portfolio investment, that is IPI. That is IPI over there. And it includes investment into the foreign securities, and these particular foreign securities can be of different manner over there. These can be the treasury bills, mutual funds, listed equities, debt instruments over there. So that's actually related to what, that first of all it's related to the direct investment or alternative investment over there, alternate investment. And the second one is related to the international portfolio investment. Okay, now this particularly involves cross-country remittance, like we want to basically transfer funds from A country to B country over there, because we want to basically invest the funds over there. That's related to it. Now the currency that will be transferred from here, that will be the local currency, and when the currency will be invested into this particular different avenues, it will be the foreign currency or the local currency of the particular foreign country over there, right? Let's take the example over here. There's a case that you want to basically invest into the US stock exchange. You want to invest in stock exchange and you are over here in India and you want to invest money into US stock exchange. Okay, now you'll be remitting rupee, and when the amount is received over here, it will be converted into USD over there. Then it will be invested into different particular pillars over there. Okay, so that's a factor related to it. After that, it's related to what are the benefits. Now, definitely, if we talked about the developed and the industrialized market over there, or the fast developing markets over there, those basically do offer a very good opportunity, right? Definitely people want to basically move their funds over there, so that they will be having more better opportunities over there. And the second one is related to they're having the variety of products which are available in those particular countries. And if it's a stable country, and particularly it has particularly it's a developed country over there, that will be providing a safety also, and lesser risk of exchange rate will be there if the currency is not that much volatile, right? And the second one is related to diversification. You're investing over here in India, we are investing in mutual funds, we are basically investing in shares over there, we are basically having the FD, RD, PPF and all the different avenues over there. But we also want some other things where we can do invest money. Okay, if I want to basically invest money in US stocks over there, like I want to basically invest money in Google or Apple or Nvidia. Okay, and it may also be the case that I want to basically invest into some private equity over there or mutual funds over there. Okay, so basically do provides us a different avenues where we can be investing the money over there. Now, what is the main funda? Now, let's the case that I'm having rupees 1,000 with me and I want to invest. Let's just take an example. I want to basically invest over there, and I just invested this money into stock A over here. Now, if the prices of stock A will grow, definitely I'll be having a benefit. Okay, that's a plus point for me. But if it dropped, then there will be a huge loss, because I invested my whole of the capital into one particular type of the security over there, right? But what if I'm going to invest this 100,000 rupees over here, not in one security, but let's say in 20 different securities, in 20 different securities. Now the prices of 2 or 3 or 5 particular shares may drop, but it will not be the case that all the share prices will drop, right? So that is particularly the benefit related to the diversification. What we say diversification, where you are not basically investing in one type of security or one type of funds, but you're investing into different type of securities or funds over there. And for the third one, what's related to the barriers, that if you're going for long term investments, in that particular case the risk is quite higher in that particular scenario, because definitely there are certainties related to uncertainty of the political and the economic field over there. Let's the case, if I'm going to invest in USA for 1 year or for 1 month, that's quite good. But if I'm going to go invest in USA for 20 years, definitely if something basically changed in between, that may basically having a risk on my investments. Okay, so that's the main related thing over there. And the second one is related to a foreign country may impose price controls. Now let me just give you an example. Like kinus are basically be produced in Punjab. Quinoas are being produced in Punjab, and the major portion of quinoa is basically exported to Bangladesh. These are exported to Bangladesh. Now, what this Bangladesh government did? Bangladesh government did the import duty in those quinoas to 70%, which was previously 10% only, increased this particular import duty to 70%. Now ultimately, if they are to buy, Bangladesh persons are to buy Punjabi quinoas, in that particular case for 100 rupees they are to pay 73 rupees extra as the import duty over there, which basically increase the ultimate cost of the quinoas over there, and the particular import decreased over there. Okay, so these kind of things may happen, due to which the barriers may be there, right? And further, it's related to language is also a barrier. Language is also a barrier, which is quite disadvantageous if you are to obtain quick and reliable information. After that, it's related to asset allocation. Now, once you have basically selected the investment objective, after that we just need to select a right mix of the risk and return. Let's say case I'm going to invest in security 1, and I know that the risk 1 is there, security 2 risk 2 is there, security 3 risk 3 is there, and I'm basically to select only 2 security out of these. Then in that particular case I'll be making a right mix of securities based upon the risks associated with them, so that I can be having a targeted return. Okay, and also there are adequate market mechanism which basically do identify high rated securities, so we can basically go for that particular mechanisms over there, where we need to identify those all high rated securities. There are different things related to it. We can go for small cap, mid cap, large cap, or high PE ratio or low PE ratio, or we can look at the value stock over there, or we can look at the different things, like we can go for debt securities, IPOs, or particularly whatsoever the security types do basically set us with our investment objective over there, we can go for that. Okay, after that it's related to hedging strategies over there. Now what do you mean by hedging? Like I just give you example related to the forward rate. Person A wanted to buy USD 10,000, but he wanted to buy 10,000 USDs after 2 months, and he's basically speculating the prices may be increased, so he want to basically safeguard himself. So basically come under a forward contract in today. He basically come under a forward contract where he bought the 10,000 USDs after 2 months at 76.30, right? So that is particularly what that is particularly he's hedging himself, he's basically safeguarding himself. But definitely when you are safeguarding yourself, you are to pay a price for the same. So we want to say that overall your profits diminish somewhat when you try to safeguard yourself. Okay, that's the funda related to it. And then after that it's related to the direct and indirect channels for IPIs, that is international portfolio investment. Okay, so what are the direct channels, what are the indirect channels? Let's have a look at it. Now we can be investing into ADRs. We are having the ADRs, that is GDRs, or American deposit receipts, global deposit receipts, or foreign direct investing, mutual funds, exchange traded funds, multinational corporations. Okay, and also we are having the indirect channels where you're not directly investing into these, but you are investing into some mutual fund which is direct in basically investing into these. Okay, so one way it's related to that I'm buying ADR. Okay, or it may be the case that I am basically going to buy mutual fund, and which way is basically investing into ADRs over there, right? That's particularly related to direct and indirect channels over there. And further it's related to exchange and country risk. Exchange and country risk. So exchange risk and country risk I've already explained to you. So we will be leaving that particular topic. Now it's related to return and risk of foreign investment over there. So whatsoever the return that will be getting your foreign investment, that particularly depends upon the type of the investment, type of the liquidity, growth, and long term, etc., etc. Right? Now, just giving an idea, let's say case that if the liquidity in particular asset is more, if the liquidity is actually more, in that case the return will be high or low. The return will be high or it will be low. What will it be? Definitely it's going to be low, because it is considered that it is lesser riskier, because it is considered that it is lesser riskier over there. So more riskier the thing is, so if we say the more riskier the investment is, more return that you are going to get. More riskier and more return you're going to get. That's the fundamental related to it. Okay, so the secured assets will be giving you lesser return, and the unsecured will be giving you a better return over there. And investment in the country where the foreign exchange rate performance is good, you can be getting better returns over there, right? And for the international investment, definitely there is exchange risk, there is country risk which is present. Now we'll be considering the CAPM, that is a capital asset pricing model. Okay, so what does this model basically say? This model is actually a relationship between the risk and the returns. So it's basically a relationship between the risk and the returns over there, and specifically from the systemic risk and expected particular returns over there. Now what is systemic risk? Let's say case that there are 4 institutions, A, B, C, D, 4 institutions are there. Okay, now these are highly interrelated. These are highly interrelated, and further they are having the interrelations with each other over there. Now for that particular purpose, what will happen if one of the institution does fail? If one of the institution does fail, in that particular case it may lead to the failure of the other institutions also, right? And for analysis of the same, the investment purpose basis, what we do say, we say that if the risk associated with firm A is this much, and overall index, and the overall index or the market index is having the risk over this much. Now what is the risk as concerned with the overall risk over there? That's actually related to the CAPM model over there. So beta is actually generated. Beta is actually generated over there, and we look for that particular thing over there. Okay. So beta is basically measure of what? Beta is volatility, is measure of the volatility or the systemic risk as compared to the market as a whole. Now we say that ABC is performing this much, and further the complete market is performing this much. So beta is actually based upon the same, right? Now it is divided. It is basically calculated how we can do calculate the beta over there. It's basically calculated by dividing the product of the covariance of securities return. Product of the covariance of the security return. So whatsoever the returns that we are getting from the average, the covariance of the same, and further divided by the market return variance for some specific period over there, that will be what? That will be related to the beta factor over here, right? Now for the calculation of CAPM, we are having the cost of equity that is represented by RE, and cost of equity is equal to what? It is equal to risk-free rate plus levered beta multiplied by market risk premium over there. And cost of equity, we can represent it by symbols over there. Risk-free return is represented by RF over here. Levered beta is represented by beta L over there. And particularly the market risk premium is represented by RM minus RF over there, where RF is the risk-free rate and further RM is the expected return on the market over there. So this is how we can calculate the cost of equity. Okay, so this is as per the CAPM model, where we look for what? We will look for So this is the cost of equity that we calculated. So simply it is equal to RF, that is risk-free rate, levered beta, beta L, multiplied by market risk premium, which is basically RM, that is expected return on the market minus the risk-free rate over there, right? Now let's understand these particular terms over there. So it's related to risk-free rate. Now, risk-free rate is particularly that particular rate that you will be getting where that is actually no risk factor is particularly covering it. Okay, so particularly let's say that we say that we'll be earning a return of 12% and we are considering no particular risk over here. This will be our RF, that is a risk-free rate over there. And what is market risk premium? Market risk premium or MRP or simply RM minus RF over there, that is actually difference between the expected return on the investment and the risk-free rate over there. And beta, as I told you already, that actually it's a division of what? It's division of covariance of the expected return on the security over there divided by the covariance of the market return over there, and it's covering the systemic risk. Okay, further it's related to the arbitrage pricing theory. Okay, so arbitrage pricing theory is what? It is alternative of the CAPM method. Now CAPM method we have already covered, and further it's the alternative of the CAPM method over there, and it's a linear, it basically indicates a linear relationship. It indicates a linear relationship between two things. One thing, it's related to the assets expected return. Let's say this is our asset and we are basically expecting some particular return out of it. So first factor is this one, and the second one is related to the macroeconomic factors. It's related to the macroeconomic factors. So arbitrage pricing theory is basically indicating the relationship between these two fundas. It is basically indicating the relationship between these two fundas over there. So macroeconomic factors, it could be related to the inflation, it could be related to stock indices, it could be related to the gold prices over there. So what sort of the macroeconomic factors are there? It basically indicates a relationship between the macroeconomic factors and the assets over there, right? Now let's have a factor related to it. Its basic question says over here that if the following four factors have been identified as explaining a stock's return and its sensitivity to each factor and risk premium associated with each factor have been calculated, RP is calculated. Okay, so gross domestic product, basically beta is 0.6 and RP is 4%. Inflation rate beta is given 0.8 and for the RP is 2%. Gold price is beta minus 0.7 and for the RP 5%. Sensex index return beta 1.3, RP 9%. Risk-free rate is also given, and we need to use the APT formula. APT formula, that is the arbitrage formula over there, that is related to the arbitrage pricing theory formula over there, and we need to calculate, right? Now, for that particular purpose, we'll be calculating the expected return as what? We will be calculating the expected return as RF, that is a risk-free rate, that was equal to given to be 3% over there, and for the beta multiplied by what? Beta multiplied with the risk premium over there. Beta multiplied with the risk premium. So we basically multiplied the beta 0.6 with 4%, 0.8 with 2%, minus 0.7 with 5%, and 1.3 with 9% over there, and added them up all, and we basically concluded it to be 15.2%. So this is the expected return that we have calculated. So this is the expected return that we have calculated over there, right? And for the APT, that is the arbitrage pricing theory, helps the arbitrators that they particularly can take the advantages of the deviations in the fair market value. Now, who are the arbitrators? Which basically are dealing in the different markets at the same time, and for the exploiting the conditions of the different markets so as to make the profits out of them, right? That's particularly related. Then after that, it's related to the international capital budgeting. Now, capital budgeting is actually required for what? Capital budgeting is actually required whether we should be going for this project, yes, or we should not be going for this particular project over there. Okay, so that is a decision that has to be made over there, and we were using the different methods. Let's say we were using the NPV, that is a net present value, or we were using the IRR over there, or payback return method over there. We were using different methods over there, right? Definitely, if you want to basically set aside a project abroad over there, we want to basically look for that whether we should be going for the project over there or not, and what are the different things we must be looking into. We must be considering different risks over there. So all the things must be looked into, and for the international market also, the capital budgeting is to be done. So it's related to the project evaluation. It's related to the project evaluation. Now project evaluation is actually related to what? Project evaluation is basically related to a process over there, a strategy over there, which can be used so as to determine that whether a project should be taken or not. Okay, so whether a project will be successful or not, and if not, what is the impact. Okay, so we are to go for that. And evaluation of the project may be related to what? That we may be changing the internal workflows, we may be identifying some patterns over there which are to be looked into. We can be looking for the projected intended audience over there, or we can be formatting new plans over there. Okay, so these are the different things we can be looking into if we are doing the project evaluation. Now what are the issues related to the evaluation of the overseas projects over there? First of all, it's related to that, so as to calculate the discount rate, it's quite difficult. It is quite difficult over there. Now see, the risk-free rate, or we simply can say the discount rate over here, that is readily available, whether we are basically looking for the home country discount rate, whether we are looking for the Indian discount rate, or we are looking for the foreign country discount rate over there, that is readily available. But the risk premium rate for the foreign country is not easily available. Now the following data is provided to you. The risk-free discount rate is given to be 4%. The risk-free discount rate in India is given to be 7%. Risk-adjusted discount rate required by the company in India is 12%. That is particularly a risk RP over there is given over here. RP is provided to us, that is 12% over there, right? Now, for that particular purpose, we need to calculate the risk-adjusted discount rate in USA. Risk-adjusted discount rate in USA over there. So RP particularly for USA is to be calculated, right? Now risk-adjusted discount rate is particularly given over there. That is RA to you is given. RA to you in India is given, and particularly that is given to be 12% over there. And for the risk-free rate in USA is 4%, risk-free rate in India is 7%. Now you will be using the simple formula, that is equal to 1 plus RA is equal to 1 plus RF multiplied by 1 plus RP. Now first of all, we'll be calculating the risk premium rate for India. We will be calculating the risk premium for India over there. That will be calculating as what? RA is 12%, so 1 plus 0.12. RF, risk-free rate in India, is given to be 7% over there, so 0.07 over there. And from here we calculated 1 plus RP to be 1.0467. And particularly we'll be using this particular term in particular case of the USA terminology. That is particularly this is a risk-free rate in USA. And further this term, basically the risk premium came from this particular equation over there. Okay, and we calculated what? We calculated 1 plus RA over there, and risk adjusted rate can be calculated as 1.0888 minus 1, that is 0.888, that is equal to 8.8%. 8.88% over there. This is what? This is our risk adjusted discount rate for US, right? So this is quite basically complicated so as to calculate the risk adjusted discount rate for the foreign country. And further it's related to estimating the exchange rate in the future years. Now see, it may be the case that you are basically going to invest in the country for a longer term. Let's say you are going to invest there for 5 years. Okay, first of all, you're anticipating that you will be getting these much cash flows or these much cash inflows over there, and moreover you have to basically convert all those cash flows, because whatsoever cash flows you're going to receive, you are going to receive those all cash flows in foreign currency. You're going to receive all those cash flows in foreign currency, so those are to be converted into rupee. Those are to be converted into INR over there at the prevailing rate. Prevailing rate means at that particular rate at which we will be receiving those cash flows over there, because we are basically anticipating that we will be receiving 10,000 USDs after 1 year or 50,000 USDs after 2 years, but we do not know what price that will be, what foreign currency exchange rate would be applicable at that particular time over there, right? So we need to calculate, and further for that particular purpose, let's have a look at the data over there. The notional risk-free Indian rate is given to be 4%. The notional risk-free interest rate in India is given to be 7% over there. And for the current spot rate is given to be 80 rupees over there. And we have to calculate the estimated spot rate. Estimated spot rate for each of the years of the projected life. Let's say case for first year, we'll be receiving the 10,000 USDs, 20,000 USDs, 30,000 USDs, and so on. Now, for that particular purpose, what USD exchange rate would be, what Indian to USD exchange rate would be applicable at that particular time for all these inflows, that is to be anticipated, that is to be calculated, right? And further, It is related to, there are two different approaches related to evaluation of the overseas projects over there. There are two different approaches. One it's related to home currency approach. One it's related to the home currency approach. In case of the home currency approach, whatsoever the cash flows will be, those are actually converted to the home currency first of all, right? So we will be estimating the spot rate at the time of the cash flow over there. So whensoever the cash flow will be there, we will be estimating the spot rate at that particular time over there, and further we will be converting them into the home currency over there, and after that those particular cash flows are discounted to the present value. Now, if you remember that we covered the NPV method, let me just remind you a little bit. So this is NPV method over there. Let's say 0, 1, 2, 3, right? And you basically received 10,000 in first year, 10,000 in second year, and 20,000 in third year over there, right? Now, if you have to basically convert the cash flows into foreign currency, if we are to convert the cash flows into foreign currency, we have to discount these values. We have to discount these values to the present value over there, and for that particular purpose we multiply the cash flows with a discount factor that is equal to 1 divided by 1 plus r raised to power n over there, right? Is that clear? But now let me just tell you that you received all these amounts in USD, over there. For that particular purpose, what will you be doing? First of all, as per the home currency approach, we will be estimating the spot rate. First step is related to estimate the spot rates over there. Estimate the spot rate. So whensoever the cash flows will be there, we are to estimate the spot rate. And once we have calculated the spot rate, we will be calculating the exchange value. We will be calculating the exchange value of these cash flows over there. So for particularly we will be converting these cash flows into INR, that is a home currency. And third step it's related to, we will be discounting these cash flows now. So as to calculate the NPV or the IRR over there. So that is the terminology that we need to use. That is the method that we need to use over there. Okay. So let's consider the fact over there. As per the home currency approach, we are provided with example. Initial investment is given to be 100, and further we are provided the first cash flow 30, 40, 50 over there. The risk adjusted rupee discount rate is given to be particularly required by the company which is envisaging project in USA over there. That is actually given to be 12%. Though this is particularly the RA in India, it's given to be 12% over there. The notional risk-free interest rate in USA is 4%, and particularly in India it's 7%. Current spot rate is given to be 80 rupees over there, and we have to calculate the present value of the cash inflows of the project which has a useful life of 4 years, and using the home currency approach we need to use that, right? And the second method, it's related to what? It's related to the foreign currency approach. Second method. First method I told you it's related to the home currency approach, and the second one it's related to the foreign currency approach over there, right? Now as per the foreign currency approach, the cash flows which you are going to receive in future time, you will let them be remaining in the foreign currency only. You'll be let them remain in the foreign currency only, and we'll be applying all the things over there like discounting and all the things that is to be done. And further after that you will be applying the method. After that you will be converting them into the home currency at the present spot rate over there, right? For that particular purpose also we are providing the different data over there, and we'll be solving the things related to it. And further we'll be solving on different patterns. First of all, it's related to if we have to basically calculate the payback period method, if we have to use a payback period method. Now if you remember, what is a payback period? Let's the case that you received in first year 10,000, in second year 10,000, in third year 10,000, and your initial investment was, that is I0, it was 20,000. What will be the payback period? Payback period will be 2 years. Payback period will be 2 years over there, right? Is that clear? Now we are to basically use that particular payback period method in the IPI, right? For that particular purpose, if we have to use a home currency approach, what we'll be doing? Let's say the case that we are receiving this in USD. All these amounts mentioned are in USD. For that particular purpose, first of all, we will be estimating the spot rate. We will be estimating the spot rate over there, and there is a simple formula related to it. That is S1 is equal to S0 multiplied by 1 plus RF divided by 1 plus RP raised to power N over there, right? So this is the formula that we need to use over here. This is the formula that we need to use over here, and simply then we can be basically be calculating what we will be calculating the spot rate over here. And this particular spot rate is actually to be estimated for each and every cash flow. This is particularly for the first cash flow, and for the second cash flow it will be equal to S2 is equal to S1 multiplied by 1 plus RF divided by 1 plus RP raised to power n over there, right? And so on. Once we have actually estimated the spot rate over there, we will be converting the foreign currency amount into the INR, and after we have converted the amount into INR, then we'll be basically be applying our payback period method options over there, right? So that is the methodology that we need to follow over there. So one question is given over here. It says the cash flows in home currency are calculated. So we are already provided with the cash flows in home currency. They have basically done the task related to the estimation of spot rate is already done, and they have converted the amount into the foreign currency to the home currency already, and those cash flows are given to us, right? So the initial investment is particularly minus 8,000, so there will be outflow, so minus 8,000 over there. First cash inflow is 2469, second year, third year, and fourth year. Okay, now if we're going to basically check the payback period, so we need to check basically that in what time period we will be getting back 8,000 lakhs over there, right? So we'll be adding up 2469 3387 first of all, and the amount is equal to 2469 plus 3387, that is equal to 5856, and after that it's equal to 4356, right? But that will be basically be exceeding 8,000 lakhs over there. So let's check the difference between these two now, that what difference is there. Okay, so it is 8,000 minus 5856, and that is equal to 2144. So basically 2144 are to be covered in 4356. So this will give us a figure equal to 2144 divided by 4356, that is equal to 0.492. That is equal to 0.492, or simply we can say what? So simply it will be equal to 2.492. 2.492, that will be the payback period over here. Okay, so this is how we can be calculating the payback period over here. And what if we are to calculate the NPV method? In this case also the same methodology is to be used, that first of all estimate particularly the spot rate, and further convert the foreign currency cash inflows into the home currency over there, and after that convert the initial investment into the present value. Now in case of NPV, whatsoever the inflows we were having, what are the inflows we were having? First of all, we did what? We basically estimated the spot rate. Okay, spot rate, and the second one it's related to convert it into home currency. Okay, third one is related to discounting is to be done. Now discounting will be done at 1 divided by 1 plus r raised to power n over there. That will be done, and after that we'll be algebraically adding all particular inflows and outflows over there, and that will give us NPV. So if the NPV is positive, take up the project. If it is negative, don't go with the project. And further, if it is zero, there will be indifferent decision over there, right? Now let's have a look at the question over there. It says in the above question, the present value of the cash flows in the home currency is calculated to be 10,852. So we have already calculated the present value over here. Okay, so the present value for these particular cash flows we have already calculated, and it basically calculated to be 10,852 lakhs over there. So the NPV equal to what? NPV will be equal to 10,852 minus the initial investment over there. That will be equal to 2,852 lakhs over there. That will be equal to 2,852 lakhs over there, right? And the third one, it's related to internal rate of return for the home currency approach. Still same things are to be done. What is to be done? First of all, estimate the spot rate. After that, convert into the home currency over there. After that, discount the things over there, and for the discounting is to be done at IRR. That is IRR. IRR is particularly the discount rate at which your NPV becomes zero. At which your NPV becomes zero. So for that particular purpose, we'll be using the hit and trial method, and we will be calculating the IRR over there. So if for the independent projects, let me just tell you how to conclude the decision. So for the independent projects, if your IRR is greater than the cost of capital, then undertake the project. And further, if there are two different projects and the cost of capital is basically same in both the projects over there, in that particular case, go with the project which is having the highest IRR, right? And further, we are provided with the question over here. The same data is given, and basically we'll be using this particular methodology over there. Then we'll be using the trial and error method over there, and we calculated IRR to be 27%, right? Then further, it's related to profitability index. Now profitability index is actually related to what? The profitability index is related to, we we divide the PV, that is the present value, is to be divided by the initial investment. Private the particular present value, not the private value, it's the present value. So present value is to be divided by the initial investment over there, and that is your profitability index. So higher it is, better it is. Higher it is, better it is, right? So in the previous question, we were already provided with that the present value was given to be 10,852. Initial investment is 8,000 over there. So what will be the profitability index? It will be 10852 divided by 8,000 over there, and it came out to be 1.356 over here, right? So this is how we can calculate the profitability index using the home currency approach. Okay. Now after that, it's related to evaluation methods using the foreign currency approach. Now if we are to use the foreign currency approach, what was the methodology that was to be used? First of all, we do what? We let remain the foreign currency inflows in foreign currency only, and whatsoever the methodology is to be applied, like in the case of payback period, whatsoever methodology is applied, we'll be using that particular method. In the case of NPV, that particular method. For IRR, for profitability index over there, right? And once we have calculated the final amount, we'll be converting into the home currency using the present spot rate. Using the present spot rate, we'll be converting into the home currency over there, right? Because when we are going for the foreign currency approach over there, we are not to estimate the spot rates over there. Spot rates are not to be estimated, right? Now let's have a look at the questions over there. So first of all, it's related to payback period. Okay, so we are provided with the initial investment USS 100 lakhs, first year, second year, third year, fourth year data is to be given over there, and we have to calculate the payback period. Now payback period would be equal to what? We basically got 30 lakhs over there plus 40 in the second one, and we are left with what? We are left with 30 lakhs, and 30 lakhs are to be covered in from the 50 lakhs over there. So this would be equal to 2 plus 30 divided by 50, that is equal to 2.6 years over there. So that is actually the payback period that is to be calculated, right? Okay, in that particular case, you need not to convert it to the home currency, because in particular payback period, conversion is not required. In the second scenario, it's related to that we have to calculate the discount rate. We have to calculate the risk adjusted discount rate for the foreign currency over there. That is, we need to calculate RA for USA. RA for USA. And if you remember, we have already basically understand that how we can calculate. So it is equal to 1 plus RA is equal to 1 plus RF, 1 plus RP over there. Now first of all, we will be calculating 1 plus RP. Then further we will be calculating the RP from the same, right? Is that clear? Like we basically calculated in the very first question, right? And after that, it's related to discount rate will be used so as to discount the cash inflows. Now whatsoever the cash inflows were there, like we were having the previous question, 30 lakhs, 40 lakh, 50 lakh, 50 lakh over there, we'll be discounting them using that particular discount rate, risk adjusted discount rate for the foreign currency over there, and further we'll be calculating the net present value over there. Okay, now finally, when we have calculated the net present value, we'll be doing what? We will be converting them into the home currency by multiplying it to the present spot rate over there, right? Now let's have a look at the question over there. In the question above, the risk adjusted discount rate applicable for the cash flows in USS, that particular discount rate, the risk adjusted discount rate for USA, that is particularly calculated to be 8.9%. 8.9% over there. Now we are to basically discount all the cash flows, all the cash inflows over there. So let me tell you again that discounting factor formula is equal to what? It is equal to 1 divided by 1 plus R raised to power n over there. For the first year, it will be equal to, if the discount rate is 8.9%, it will be equal to 1 divided by 1 plus 0.089 raised to power 1 for the first year. And for the first year, the cash flow was equal to 30 lakhs. For the next year, the cash flow was equal to 40 lakhs over there, 40 lakh USS, and that will be equal to 40 divided by 1.089 raised to power 2. For the third year, it was 50, so it will be 1.089 raised to power 3, and also for the fourth year it was 50, so 1.089 raised to power 4 over there, right? So this is how we will be calculating the present value, and after that we will be subtracting the initial value, that is of 100 over there. That is of 100 over there. We'll be subtracting that particular value over there, right? We subtracted, and particularly once we have subtracted the value, whatsoever the difference will be left with us, we will be multiplying it with the present spot rate over there. We will be multiplying it with the present spot rate over there, and that will be our NPV. That will be our NPV as per the FCA, that is a foreign currency approach, right? The third method over here, it's related to internal rate of return. Again, we have to calculate the risk adjusted rate for the foreign currency over there using this particular formula over there. And after that, we'll be going for a hit and trial method over there, and we'll be calculating the IRR. Once you have calculated the IRR, so we'll be saying what? We'll be saying that if IRR that particularly we calculated over there is whatsoever IRR we calculated, if that is actually greater than the RA, RA over there, risk adjusted rate for the foreign currency over there, in that particular case, take up the project, otherwise not, right? So this is what we can use over there. We basically can calculate it the same by a hit and trial method. We calculate it to be 35% over there. Now 35% is actually greater than 8.9% over there. So definitely go with the project over there, right? And the fourth one, it's related to the profitability index. So first of all, again, calculate the RA. And further discount the values, calculate the present value over there, because profitability index is equal to what? It is equal to your whatsoever the present value is there divided by the initial investment over there, right? And this is how we can calculate. So whatsoever the present value that we'll be calculating over here divided by the I, and that is how we can calculate the profitability index over there, right? Is that clear? Okay, so this is how we can use this particular methods, and further we can make use of the foreign currency application and for the home currency approach over there, right? So these are the two different approaches that we need to use. Further, it's related to impact of transfer pricing. Now, as I already told you, related to transfer pricing, let's say case that market ABC is there. ABC company is there, and it's having a subsidiary over here in other country, and they have to transfer the products over there. Now, definitely they will be using some methodology which will be beneficial to them, but that may not be beneficial to the others, and that may be basically deterrent to the others over there, right? So for that particular purpose, the transfer pricing methodologies are being used, and further there is a proper guide by the OECD, that is the Organization of Economic Cooperation and the Deployment over there, that's actually been trying and successfully has done so far, so as to eliminate the unfair trade practices if there is any. So if there will be any unfair trade practices between the same concerns who are basically having the relationships in the international market over there, for that particular purpose, we are having the standardized procedures which are particularly given by the OECD over there, right? And particularly, let me just tell you, as I told you already, that it may be the case that ABC and XYZ are not dealing directly, they are dealing through some tax haven country where there is no tax applicable, or little tax is applicable, so as to safeguard their taxes, over there. So for that particular purpose, OECD has recommended the transfer pricing rules over there. Okay, so these rules actually do apply to the international transactions that may take place to related parties over there. So even though the two parties are related to each other, the particular rules will be applicable. Right?